This is a wake-up call for every investor who wants real results. Smart money has been compounding near the low 20s in the best sector, while many accept 8% and hope for the best. I am George with ChannelVest, and today we reveal the sector rotation playbook that professionals rarely explain. We will keep this friendly and precise with numbers you can verify and steps you can follow today. Our guiding idea is simple. Different sectors lead in different phases, so we tilt towards strength while keeping a core. If this already helps, subscribe and comment to join our investor community. Here's what you will get in this session: a clean definition of rotation, the evidence behind it, a cycle map, a risk and cost check, a starter plan, and an educational watch list. We will also show the traps that cause investors to bail at the worst time. Stay with me, because the next section sets the ground rules and builds confidence for the journey. ChannelVest provides research only, not an advisor, broker, or fiduciary. Education only. No personalized advice, no affiliate income. Full disclosures and description. This video is for educational purposes only. We are not registered investment advisors and do not provide personalized financial advice. Always consult with qualified financial professionals before making investment decisions. Past performance does not guarantee future results. All investments carry risk of loss. The strategies discussed may not be suitable for all investors. Let me break down what matters here. Across the last decade, the technology sector posted about 21.43% annualized, while the average investor sat near 8%. That gap compounds into different lives. $10,000 in the leader becomes a very different number than the same $10,000 in a laggard. Add one more tell, roughly $84 billion sits in a single technology sector fund, which shows where large institutions focus. Authority matters, yet process matters more. We use numbers for clarity and rules for consistency, so our actions match our investor identity. If this perspective is already useful, subscribe and drop a quick hello to join the community that studies markets together. In a moment, we will define rotation in clean language, then build a simple checklist for entries, sizing, and review cadence. Keep that idea in mind, because the next section turns a buzzword into a practical map you can follow without guesswork. Here is the clean definition we will use. The economy tends to move through four familiar phases: early recovery, expansion, late cycle, and recession. Different sectors lead in each phase because profit drivers, credit, and sentiment shift. Smart money rotates toward the sectors whose earnings and financial conditions are improving fastest. Do not try to call exact turning points. We watch price leadership, relative strength, and a few simple macro signals, then tilt toward strength while keeping a diversified core. Our aim is consistency, not hero trades. We write a checklist, decide position sizes in advance, and schedule reviews so emotions do not run the account. If the plan resonates, subscribe and tell us which sector you want next so we can build future sessions around your needs. With that foundation, let us inspect the performance spread that makes rotation worth the effort and see how a small tilt can change your compounding over time. This is about stacking small edges applied calmly, so outcomes improve without drama. Here is what the numbers actually tell us. The last decade, technology delivered about 21.43% a year, financials near 12.26, utilities around 10.50, healthcare near 7.78, and energy about 6.26. Start with a simple thought experiment. $10,000 in the top sector compounds toward roughly $67,000, while the weakest path lands near $18,000. Election matters, but leaders rotate as cycles evolve, so we avoid falling in love with any single theme. We date sectors for the phase, then rebalance on a schedule. Our checklist is short: confirm leadership with price and relative strength, size positions modestly, set a quarterly review, and log decisions. That routine creates consistency without heavy trading. Up next, we bring the view to the present and study what has led in 2025 so far, so you can see how the process turns into timely action you can repeat. The key insight that jumped out this year is how defense and growth share the podium. Year to date, utilities are up around 13.24%, technology near 13.06%, and financials near 11.36%. Mangs is cast. Laggards include healthcare near 0.07% and energy near 3.31%, and consumer staples look tired. What do we do with that? We confirm the scoreboard, tilt toward the leaders, and right-size exposure so one theme cannot sink the ship. We avoid chasing every wiggle by using a review cadence with monthly reviews and a quarterly rebalance. If this clarity helps, Hit subscribe and tell us in the comments which market you want next, because your requests shape our roadmap. Now that we know who is leading, let us check whether prices still make sense relative to growth, so we avoid paying premium prices for yesterday momentum. The goal is not perfection. The goal is alignment with data expressed through measured moves that compound. If we cut through the noise, the PEG ratio compares price to growth and helps spot fair value. The broad market sits near 1.74. Below that line, growth may be inexpensive relative to price. In this data set, financials near 1.51, technology near 1.57, and energy near 1.59. That suggests select leaders are not just popular, they may still be reasonably priced for the growth ahead. We never rely on one metric, so we pair valuation with trend confirmation and risk control. A simple rule works: buy strength that is not expensive by your standard, then size small and review on schedule. If you want more deep dives like this, subscribe and comment with the metric you trust most, so we can build the next session around it. With valuation mapped, let us follow the money to see where large pools of capital are actually parked today, since flows often reinforce trends you can ride with discipline. Money leaves footprints, and assets under management reveal them. Technology. ETF XLK holds roughly $84 billion. Financials through XLF hold around $49 billion. Healthcare through XLV sits near $36 billion. Large funds often move in steps rather than spikes, which can create durable trends and cleaner entries for patient investors. Liquidity also matters when you need to rebalance without drama. We do not blindly follow flows, yet we respect where the tide is strong, because repeated institutional behavior can support leadership for longer than expected. The combination we want is trend leadership, acceptable valuation, and deep liquidity, wrapped in a simple plan we can run consistently. Now that we have seen where capital is concentrated, let us translate the business cycle into a practical map that links phases to likely sector leaders, so you know what to watch and when to adjust with purpose. When those pieces align, we can act with confidence, because the process depends on observation and discipline. Here is the cycle playbook we use to frame decisions. Early recovery often favors technology, consumer discretionary, and financials, because growth snaps back and credit loosens. Mid-expansion tends to lift energy, materials, and financials, as demand and rates rise and pricing power improves. Late cycle usually rewards healthcare, consumer staples, and utilities, as growth slows and investors grow defensive. In recessions, utilities, staples, and healthcare often hold up best, as cash flow quality and dividends matter more. We are not trying to be perfect forecasters. We are trying to be prepared operators. We watch which sectors show relative strength. We confirm that leadership with basic macro context. Then we size positions with humility and rebalance on schedule. Keep this map in mind as we talk risk and reward next, because the goal is not to avoid volatility. The goal is to choose it on purpose in the right amounts for your plan. That mindset turns uncertainty into a series of manageable decisions that compound over time. Risk and reward live together, so we choose them on purpose. Technology shows higher volatility near 28.4%, yet also a solid Sharpe ratio near 0.84, which signals strong payoff for the risk taken. Energy tends to swing wide, with big upside and deep drawdowns that require smaller sizing and patience. Financials offer moderate risk with solid returns in many cycles. Industrials show a steadier profile, with a Sharpe ratio near 0.71 in the snapshot. Utilities and consumer staples work as defensive anchors, with lower swings and steadier dividends that help investors sleep at night. Your edge is matching exposure to your tolerance and timeline. We write position limits, define a maximum loss per trade, and review results so the plan improves. With risk framed clearly, the next step is cost, because fees are the quiet tax on compounding that you can control with a few smart choices. Small edges here add up over years. Costs compound just like returns, which is why low fees matter so much. SPDR sector funds charge around 0.08%. Vanguard sector funds sit near 0.10. Some iShares sector funds are around 0.42. Many active funds are near 0.85. Over 2 decades, that spread can mean tens of thousands of dollars left on the table for the same market exposure. We prefer liquid, low-cost tools, so more growth stays in your pocket. Reciprocity time. We give you clear tickers and the logic, and you give the community community your questions and results so everyone improves. With fees handled, we can design a beginner-friendly plan that respects human behavior, keeps decisions simple, and builds consistency without constant trading or screen time. Think of fees as friction that never sleeps, and think of your choices as a steady tailwind. Simple, low cost, and repeatable beats. Complex and pricey almost every time. Beginner battle plan. Phase by phase. Phase 1 for months 1 and 2, open a zero commission account, pick 3 or 4 core sectors, and keep 70% in a broad market fund with 30% in sector tilts. Phase 2 for months 3 through 6, track a tiny dashboard, price trends, relative strength, credit spreads, and a growth proxy, and journal every decision in one page. Keep positions modest, roughly 5 to 10% per sector. Phase 3 for month 6 and beyond, expand to 5 to 7 sectors, rebalance each quarter, and add some international exposure for diversification. Consistency beats excitement, so your goal is regular, boring progress. If this structure feels helpful, subscribe and tell us which step you want us to automate next, and we will build tools the community can use. With the plan in place, let us share an educational watch list so you can see how we translate all of this into real tickers and practical next actions. Community is our edge, so welcome to the investor family. We share data, admit uncertainty, and improve together through open questions and thoughtful debate. Use the comments to request stickers, ask about risks, and suggest frameworks you want to learn. Social proof matters when it is earned, and your feedback keeps us sharp and accountable. Our promise is clear. Every episode delivers useful insight and real numbers presented in plain language you can use. If you're learning something today, hit subscribe and say hello, and tell us what sector or theme should be next. Unity makes the journey easier, and your ideas often become the outline of the next deep dive. Now let us move from process to practice and walk through an educational set of positions to study, along with the why, the when, and the sizing rules we would consider in a disciplined rotation plan. Remember, this is education, not advice, and your plan should always fit your goals, risk tolerance, and time horizon. Here are educational ideas to study, not personal advice. Technology through XLK, target near 25% allocation with an entry idea around $212 and an upside idea near $235, powered by artificial intelligence demand and possible rate cuts. Financials through XLF, target near 20% allocation, but ask for a confirmed breakout near $46.50 before adding new exposure. Consumer staples through XLP, cap near 10% given weak momentum and limited growth for now. Do not predict. We prepare. We size positions so one theme cannot ruin the plan, and we review on a schedule to avoid panic. Use these as templates for your research and paper tracking. In the next section, we will leave you with a powerful question that helps you stay consistent when markets test your patience, because discipline is the edge most investors never master. Share your take in the comments and help the community refine these setups using evidence and options. Here is the deep question that upgrades your process. If rotation can work, why do so few investors stick with it? The honest answer is psychology and structure. Humans crave comfort, chase headlines, and avoid rules that feel boring in the moment. The fix is a written checklist, scheduled reviews, and small, repeatable actions that keep you aligned with your identity as a disciplined investor. Authority comes from evidence, but freedom comes from a simple process you can run even on a busy week. Make it easy to do the right thing by default, and progress will follow. If this episode helped, subscribe for our next deep dive and comment your biggest takeaway and tell us which sector you want us to analyze next. Goodbye, take care, and invest wisely. And remember that steady habits beat hot takes when your goal is compounding over years rather than days. Thank you for being part of this investor family. Your curiosity and discipline make this journey more effective for everyone.